Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, let's get straight to it. Today we're going through the U.S. market periphery notes for Tuesday, March 24th, 2026. This video presents a direct informational narration of the source document. Okay, and as always, we have to start with the important notice. This document is for informational and research purposes only, and it does not constitute investment advice. You should know that investing involves significant risk, and any strategies we talk about are for reference only. Please remember to make your own investment decisions independently, because past performance is never, ever a guarantee of future results. So here's our roadmap for today. We'll kick things off with a macro overview, then jump into the geopolitical dynamics. After that, we'll explore a really interesting war economics framework, do a flow and technical deep dive, check out cross-asset and sector performance, and then tie it all together with a strategy summary at the end. So let's begin with Section 1, the macro overview. And pay close attention to the subtitle here, the end of the headline pulse and a structural shift in the macro framework. What that's telling us is that the market seems to be moving beyond just reacting to news flashes and is now entering what could be a structurally more dangerous phase. So, what's the logic behind this shift? Well, it really boils down to this. The initial optimism about a ceasefire has pretty much evaporated. Because of that, and because of real infrastructure damage in the Middle East, crude oil prices are on the rise again. This is fueling fears of a second inflation wave, which in turn is forcing the entire market to rethink where interest rates are headed. That hope for more rate cuts in 2026? Yeah, that's fading, and it's fading fast. Okay, let's move on to Section 2, Geopolitical Dynamics. The title here says it all, military buildup beneath diplomatic noise, and the April line strategic deadline. Essentially, we're shifting our focus from what's being said at press conferences to the reality of what's happening on the ground, like direct attacks on critical energy infrastructure. And this really gets to the core of the strategic shift. The report points out that after nearly 5,000 missile and drone attacks from Iran, its neighbors are kind of shifting their stance from one of cautious observation to outright hostility, simply to protect their own interests. And for the United States, maintaining control of the Strait of Hormuz is the ultimate way to signal that global deterrence is back on the table. And this isn't just talk, there are hard numbers to back it up. We're looking at about 3,000 troops from the 82nd Airborne's Immediate Response Force. These are the units that can be anywhere in the world in 18 hours for rapid ground operations. And right alongside them, you have nearly 5,000 elite Marine units moving into what's described as a full-speed encirclement posture, with a laser focus on the Karg Island oil hub. So here's the date you need to remember, April 9th. This has been flagged as a target deadline from the White House. The thinking is, if diplomacy doesn't produce a breakthrough in the next 5 days, the base case scenario is that U.S. ground operations would kick off over the weekend or early next week. It's this not yet launched but fully deployed stance that's creating so much pressure on the markets right now. Now for Section 3, the war economics framework. And this puts forward a really fascinating, almost counterintuitive idea, that a ground war could be the trigger for uncertainty to finally clear. The theory here is that an unresolved, simmering standoff can actually be more toxic for markets than when the fighting actually begins. And you know, this isn't just a theory. We've seen this pattern play out before. The report highlights 2 key examples from history. Back in the 1991 Gulf War, stocks rallied right after the Desert Storm ground campaign kicked off. And we saw something similar in 2003, where the actual date of the Iraq invasion marked a near-term bottom for U.S. stocks. In both situations, the start of action helps to lift that heavy fog of uncertainty. But, and this is a really critical warning, this framework comes with a huge catch. It's only valid if we're talking about short, controlled, high-precision campaigns. If the conflict drags out and becomes a long attritional war, like what we saw in Afghanistan, then any initial relief rally would probably just dissolve into a much broader structural market decline. All right, on to Section 4, a flow and technical deep dive. You know, in an environment as murky as this one, the argument is that you stop listening to opinions and start following the money. Hard flow data, where capital is actually moving, is way more honest about market fragility than anyone's forecast. And wow, the data here tells a story. Hedge funds have been dumping cyclical sectors for 9 weeks straight. And at the same time, retail participation has just cratered, falling from a peak of 15% all the way down to just 8.1%. Now, that's a level that's consistent with the kind of mass capitulation we saw during the 2020 pandemic shock and the 2022 bear market low. It suggests risk appetite has hit rock bottom. You might have noticed the market's decline has been weirdly smooth, almost orderly. Well, a big reason for that is the Commodity Trading Advisor algorithms, or CTAs. Positioning charts show what the report calls a 90-degree dive. That means these automated systems have gone from just selling their long positions to now actively starting new short positions, which is adding a ton of downward pressure. Right now, this CTA positioning is getting close to the negative 40 level, which is widely considered an extreme oversold zone. But historically, when positioning gets this low, you don't usually get a sharp V-shaped snapback. It often requires a much longer period of the market just grinding along at the lows. So what do we watch for to signal a real durable turn? The report lays out two very specific technical signs. First, you want to see that CTA positioning line stop its nosedive and start to flatten out, moving horizontally. And second, the index itself needs to reclaim its 200-day moving average and hold above it for 3 days in a row. Until both of those things happen, any rally is probably just a temporary bounce. Let's zoom out a bit for Section 5, Cross-Asset and Sector Performance. This gives us a look at the whole board, from defensive assets to some really specific industry risks, like the potential for software disintermediation, which is just a fancy way of saying new tech could make some current software totally irrelevant. So here's a quick hitter breakdown. In crypto, Circle dropped 20%. The headlines blamed regulatory news, but it was probably just profit-taking. The software index fell over 4%, mainly on fears that new AI tools from Amazon and Anthropic could let users bypass traditional software. Microsoft's chart looks technically weak, breaking below key trend lines, and in the semiconductor space, we're seeing a split, with ASML outperforming thanks to strong demand, while Broadcom is lagging behind. But the real standout here, the name that's bucking the trend, is TSMC. I mean, its 2-nanometer chip capacity is reportedly already booked solid through 2028. Because of that, the report describes its outlook as entering a multi-year secular repricing phase. Basically, that suggests its pricing power could just keep rising for the next 4 years. And that brings us to our final section, the strategy summary. And the message couldn't be clearer. Stop driving through the rearview mirror and stay tactically neutral. It's a pretty stark warning against just assuming that the megacap stocks that worked in the past are going to save you in a totally new environment. So the bottom line, strategic view is unambiguous. Until that April 9th deadline is behind us, or until a truly credible ceasefire materializes, the market is just stuck in a high volatility vacuum. The recommended stance is tactical neutrality. That means preserve your cash and wait for those clear technical signals to confirm the fog is lifted before you make any big moves. And we'll end with the full professional risk disclosure. This document is provided for informational and research purposes only and does not constitute investment, financial, or trading advice. The author is not a registered investment advisor and no client relationship is formed. Investing involves a substantial risk of loss. All views expressed are for informational purposes, and any investment decision is made solely at the reader's own risk. Readers are responsible for conducting their own due diligence. Past performance is not indicative of future results, and the information herein may become outdated.